The last, but one of the most important quadrants, obviously, is financial feasibility. So we're thinking about doing whatever it is that we're doing, this new project, this new service that we want to launch. But unless we're a non-profit organisation where profit isn't our primary motive, we want to make money on this. We want there to be a positive return on investment. So we have to start asking questions as early as possible. And the earlier we're asking these questions, the more they're going to be projections. They won't be firm, but we should still be asking the questions and starting to put numbers down. So how much will we have to spend up front before we start seeing money coming in? Is this going to be a long, drawn-out development and design process, and we're going to have to spend thousands and thousands of euro or dollars before we actually see any sales revenue coming in? Is there any way that we could raise money ahead of time? Crowdfunding is becoming more and more popular for a lot of companies now because they can have money pledged and have money in the bank so that they can be relatively certain that they have now got a pot of money that they can spend on the research and development, and then obviously the initial funders are then recompensed by getting early versions of the product and getting them at a lesser amount than the normal consumer price. Because cash flow is really, really important. You have to have enough money in the bank to pay your suppliers. You have to have enough money in the bank to pay for all your materials. And the fact that you've got the promise of hundreds of thousands or millions of dollars coming in later isn't any good today when you've got people who need to pay their mortgage and take home a paycheck. So plotting out cash flows, and cash flow statement basically just plots out money coming in to the bank account and money going out of the bank account on a month-by-month basis so that you can see what your financial state is going to be at any point in time. When you get into bigger and more long-term projects, you can use tools like net present value and internal rate of return. These are tools that help you to look at the value of money over time and see whether one investment might be a better idea than another similar investment by crunching these numbers. And there's lots of functions in Excel which will help you calculate things like net present value and internal rate of return. So what you're doing here is different scenario planning by putting in the numbers for different products or different services or different lengths of time and seeing which one then would be more financially viable. But obviously you've also got to think about, well, what if things don't go according to plan financially? What if we have to spend more than we thought to get our product or our service into a state where it's ready for market? What if when we get to that point, the sales that we expected, that we'd projected, don't come in? Because if that's the case, now we're not making the money that we thought we were making. Have we got enough money in the bank to tide us over a quiet period before, sales really start to ramp up? Point 3 there, product returns. What's the risk of above average rates of product return? So you build in, an amount of product return, because most products are going to have some returns. There's going to be some failures. But what if it's twice as many? What if it's 3 times as many as we'd planned? Because product returns tend to be quite expensive in terms of you've got to contact your customers, you've got to give them a way of returning the product, you've got to warehouse that product, you've got to investigate the problems and either repair it or replace it and then get that back to the customer. And that can be quite expensive, and that can hit your profitability very, very quickly. What if your product costs in manufacturing escalate? What if you are buying raw materials from a manufacturer in a different country and all of a sudden the exchange rate changes so those raw materials become more expensive than you'd initially planned, or the travel costs involved in transporting your materials suddenly increase because, I don't know, there's a war in the Middle East and the price of petrol goes up, so the truck carriers or whatever start charging more. So you've got to kind of build in what ifs into your planning. And what if you don't make the profits that you thought you were going to make? What's the minimum amount of profit you could make to still make this a viable proposition? These are all questions around financial feasibility that you should build into your planning process.